Hello, folks. Lee Gettess here with the Market Sense for the week of February 16th, 2016. Hope everybody had a nice Valentine's Day. We're going to look at some charts that come from my Trade Navigator software. And looking at a weekly bond market chart here, boy, that was quite a week last week, wasn't it? You can see they've gotten tremendously overextended above the upper Keltner channel and everything else. So they certainly could be due for a back off here. This looks like a bit much. Here's the problem. This upper moving average is around 165.20. That's where they would hold if they were going to continue to trend up strongly, and they haven't gotten very far below that yet. They could drop down to the middle moving average. That's the green line there at 163.12. That would still look like a pretty doggone good uptrend. They could drop all the way down to 160.22 at the lower moving average. Have to say that still looks like an uptrend. And the worst thing is, if they drop all the way down to this mid-Keltner channel down here, that would coincide with this previous swing high that they broke out from. That's the mid 157 area, call it 157.16. And that's what a normal market will do when it's trending. So, boy, there's an awful lot of room on the downside that wouldn't change the trend, and it's awfully difficult to find any way to attempt to sell it to take advantage of any of that. I mean, the only thing you can see, sell it and put your stop above the high. Well, my gosh, that's more than $5,000 per contract. No thanks. So pretty tough to see any way to get involved here. They probably should go a little lower than this just because the run-up has been so hard. But hard to know how to get positioned for anything here. Looking at the stock market, they of course do not have nearly the run that the bonds do. They did come back, though. They got a little surprise over the weekend when the Chinese government raised the value of their currency after dropping it several times in the last couple months. Kind of came as a surprise, and all the global stock markets seemed to like it. The resistance to knock them back down was about 1882, and they appear to be trying to work above that. We would ordinarily be looking at the 1920 area, this moving average here, as being the next real resistance. But because of the strength of the move down and because of the projected high right in this vicinity here, I think we could look at the 1900 level and probably go 5 points either side of it and say there's still a risk that the resistance will hold somewhere in that vicinity to drive them back down. Now, by the same token, this is a marginal new low. They just took out the previous low by a marginal amount and snapped back, so they could be moving back higher. And the previous swing low that they broke down from to continue this trend is up above 1980. So, that's almost 100 points from here. So there's plenty of room for them to go up. I'm just not convinced they're that strong yet. A little concerned there might still be more downside. And, of course, the best support going into this week was down here at the 1840 area, which they've come nowhere near. But if they do, well, it's still support until it's broken. So, that wouldn't be a terrible thing. Sort of like with the bond market, though, the volatility is so high here, it's awful difficult to know how to control the risk. The best thing you got is around the 1900 level here. If they do hold somewhere in here, you've got 1920 as the next level, so you kind of know where you have to hide your stop if you try to sell them. So that's what we've got for you today. I hope you can find something profitable to get yourself involved with and control the risk.